And now I was talking about identifying your merger partner. It's what we like to call the 4 C's of M&A success. And each of them are critical in the success of any merger or affiliation. First one is chemistry between the two parties. First meeting is almost like a blind date, unless you know the person. You're hoping there's chemistry, but very early on, if there isn't, you know. If we have a saying here: if you don't want to eat lunch with someone, don't do a deal with them, because if you're not comfortable with them, why on earth would you think your clients and your staff would be? Continuity. Look around. How long have their clients been clients? How long have their partners been partners? Is there a high staff turnover? Does it look like a fast food restaurant, not like an accounting firm in terms of turnover? Culture. What's it like to work here? I mean, culture could mean anything from one firm could be a button-down white shirt and tie, and the other could be high-top Converse and jeans with tie-dye shirts. I mean, that's a big cultural chasm. What's it like to be a partner here? And more importantly, ask yourself, what's it like to be a client here? I mean, look around. Do people look happy? Do the clients look happy? Capacity. This is one often overlooked. Does a successor firm have the capacity to take you on, to replace the roles? Because, I can't tell you how many times I hear firms tell me, yeah, I want to merge, but I think I want to merge with a firm my size. Okay, fine. So you've got 2 partners that want to leave, and the other firm's got 2 partners that want to leave. So what you're ultimately doing is doubling your succession problem, because now you've got to replace 4 partners. So you have to make them see the light. So that's what we call the 4 C's: chemistry, continuity, culture, and capacity. Again, author a generic practice information, metrics, we went over this: revenues, services rendered, rates, profitability, and the lease information. I can't tell you how many problems leases, and when we talk about roadblocks that often hold up a deal, leases are chief among them. The timing for partners, who might be seeking a reduction in role, technology. One firm might be on the cloud, so to speak, with all cloud applications. The other might just be all paper. That's going to be a huge issue. What are the goals for the deal? Maybe you have individual goals for some partners. And basically, and the last bullet point is probably the most important. What does success look like? Do you have a vision of what success looks like in any merger? Okay. All right. List the deal structure you're seeking. A sale, an outright sale where someone writes you a check and you hand them the keys to the front door. A merger, a 2-stage deal, which is the most common we do. I'll go into the details of that a little later. Or a combination. List the value you seek, both in comp and valuing your equity. All right, and one of the problems, and we'll go into this a little later about a sale, is you run into the problem of client retention, because people choose accountants often the way they do their dentists, meaning that it's a referral. You've been with them a long time. You feel comfortable with them. If you've been going to an accountant, your same accountant for 20 years, and all of a sudden this next tax season you walk through, there's somebody else sitting in his chair, what are the chances you're going to use that person? Or same thing with a dentist. If you're used to a dentist and there's somebody else there and he's gone, what are the chances you're going to let this person work on you? I've been using my same accountant on a personal note since 1993 and my same dentist since 1995. So, like I said, I like to compare accountants and dentists because they're both chosen virtually the same way. Again, organize your must-haves. Items that are absolute deal breakers, such as location, partner retention, compensation. Items you strongly prefer, such as technology, staff retention, and the name of the firm. Are you going to be part of the new firm's nomenclature? That has to be decided. And items you're more flexible about, such as software. Okay, maybe you're on ProSystem FX tax software, or someone's on UltraTax, or whatever. So you should never make a merger decision on the basis of software. How about employee perks? Maybe one firm gives 4 weeks vacation and one firm only gives 3. That has to be worked out. But that's obviously you're more flexible about that than if you don't want to lose your location. Is your successor ready? Again, do you know why the other firm wants to merge? Do they have the excess capacity to take you on? I was people are surprised when we say we walk away from as many potential deals as we actually facilitate, because when something's not right, I had a client up in the Massachusetts area. He wanted to merge, but his own firm was a mess. He didn't have the capacity. He barely got his own work out, and he was going to take on $2 million more in business. I said, Joe, you can't do this. You're not ready. We'll revisit this in a couple of years when you get your own firm back in shape. How about the space requirements, technology and equipment? How about financial strength? You part of the due diligence process. If you're a seller firm, one of the things you can ask for is a credit report. You can see, if there's any outstanding credit issues with them. Or you can go to the local state board of accountancy, see if they have any violations. Again, remember, bigger is not always better. It can be, but it's not always. Better is better. Again, have your initial meetings, share your information, goals, and must-haves. Again, be very open, discuss what success looks like, and narrow the playing field, and those you send to the back of the line. Okay, I had just touched on this a little bit. I want to go into a little bit more detail. You've already told them what you want, what you have, and what you want. You should, if you're the seller firm, you should require a non-binding offer that shares with you what the deal looks like, philosophically, financially, obviously pending due diligence. Usually 95% in most cases, due diligence turns out to be exactly what everybody said. No huge surprises. Obviously there are some, but usually due diligence is not a problem. Make sure the terms are complete as to your must-haves and your deal structure. Okay, as far as ways to merge, all right, this is actually the sort of the nitty-gritty. Again, methods to structuring the transition of a practice through an external sale, meaning you're going obviously outside your firm. There's the straight sale, which is like, again, I had mentioned somebody writes you a check. Somebody says, here, Bill, here's $1 million, give me the keys to the front door. Now, the problem with that is you've already got the money, so it's not really critical to you, but the buyer runs the risk of having a large client exodus because there's been no, we had talked about that, the client handoff and that trade, there's been no transition. So that's one of the problems. The second one, we don't see too much buy-in to a buyout where a buyer opts in an interest into the firm and he may or may not bring clients into the newly combined entity where he gets a piece of it. That's not too common. It does happen sometimes. Merger or a buyout, carving or culling out clients, meaning that if I'm a big tax firm and I'm looking at a smaller firm, but they've got some really low-end 1040s that I don't want, I'll let them either buy them or get rid of those clients before we do the merger. So that's called a cull-out sale or a carve-out sale. And the most popular one that we do is what we call a two-stage deal, where you sell the equity of your firm but stay on. And there's less exposure as far as client loss than examples 2 and 3. And I'll explain a little bit how that works. Okay, this two-stage deal. Okay, if I want to transition out from full-time in 5 years, all right? I'm a seller firm and I go to a larger firm. They calculate my net. They calculate the labor that I use to achieve my net. So say I make 40, my firm makes 40%. All right. Okay. You say, okay, Bill, all right, you make 40% now. You're going to make 40% for the next 5 years till you slow down. All right. Provided that you maintain the same hours you do currently. In other words, I can't be working 45, 50 hours a week and all of a sudden I slow down to 10 and expect to get the same compensation. Or if I suddenly lose a large client, obviously my compensation would have to be adjusted. But for 5 years, say everything remains status quo, for 5 years until I slow down and my buyout begins, I'll be making the same amount of money. The buyer firm, let me go to the next slide, my successor firm takes on all the costs of the overhead, labor, rent, administration, billing, all the little nitty-gritty things that I don't like to do. And then once my buyout begins, I'm getting paid on my gross collections from the original clients. So if I slow down, we're 2018, so if I decide to slow down in 2023, going forward from 2023, my buyout begins and I'm paid on client retention. There's tax advantages to both parties, and the time commitment is not that critical a factor once my buyout begins. Advantages to me, the seller, it's like a practice continuation agreement, and most of you know what that is. If it isn't, it's just if you're a sole practitioner and suddenly you get hit by the bus, you've made an agreement with someone to take over your practice in the case of death or disability. It mitigates the loss of client fees. Okay, as an example, say I was making, in the example I gave previously, if I'm netting 40% in my practice and I lose a $20,000 client, if I didn't merge and I lost a $20,000 client, I would be out $20,000 because all my other costs are fixed, my overhead and everything else. But if I merge, the other firm assumes everything, and I lose a $20,000 and I lose a $20,000 client, my loss actually, if I'm making 40%, is only $8,000. So there's, so it's a sort of a hedge against losing clients. You're working less since the administration and other items, and this you have more time to A, transition, and B, for new business development. And of course, the true barometer, the success barometer for any merger is the higher client retention. And obviously, the more clients you retain after your buyout begins, the more money is in your pocket. Okay, what if you say, Bill, what happens if I'm like a 5-partner firm and 2 partners maybe want to slow down and the others want to stay on? Okay, so and that's true. Most multi-partner firms are in this situation. Partners seeking immediate role reduction do a sale, and if they want to get out, they sell. They're immediately bought out. Partners seeking to slow down to 5 years or less, which is what the example I gave in the slide before, do the 2-stage deal. And the partners looking, maybe the younger partners who want to work, 15 to 20 more years, maybe they've got young children that still need to go through secondary and college educations, then they're looking to be part of that firm's succession team. They want to get an equity stake, and so they become either equity or income partners with a path to equity. So there's ways around all kinds of scenarios, and trust me, we facilitated over 900 mergers, so we've seen every situation at least 3 or 4 times. Okay, again, one of the most frequent questions we get asked is, we're talking about multiples. They always say, Bill, what's the multiple? What's the multiple? What's the multiple? And I keep saying, the multiple is dependent on 5 variables. And we're just going to go over those quickly. People say, I want 1.5. No, you're not going to get 1.5. Nobody gets 1.5 anymore. Here's what goes into determining a multiple. Cash up front, if any. All right, so and what I mean by that, if I'm a tax firm, and 90% of my clients are 1040s, and I close a deal, a merger deal, I merge up with a firm in August, 95% of my revenue for that year has already been collected. So my successor firm might have to operate my practice at a loss until the next roll over till the next tax season. So there's if they get any cash up front, it's going to be very, very small. So then you get the retention clause, collection deals, fixed deals, limited guarantees, or the economy clause. And I had mentioned what an economy clause is a couple of slides back. Say if you're in a local market and you have a lot of construction clients, and that all of a sudden that industry, the bottom falls out, you could always build in an economy clause. If this happens, then this happens. Okay, profitability, the seller's current profitability, the billing rates, and the buyer's anticipated profitability for getting that. Again, if you buy a tax firm or you merge with a tax firm in August or September, you're not going to see any money probably until April. So that's got to be figured in. And then the tax ramifications of deal structures, goodwill versus current deduction, and of course the length of the payout period. The longer the payout period or the shorter the payout period. Okay, and the multiple cause, multiple is the cause versus the effect. The multiple is the effect, and those other are the cause. The basic rules just to keep in mind: lower down payment, longer payout period, higher profitability, longer guarantees equal a higher multiple. And then tax clients versus traditional accounting clients. Tax clients tend to be valued a little less than, say, consulting clients or for some of the higher end services. So these are some of the factors that go into determining the multiple. Now, also, what it's not stated here, but geographically, it also depends, because I happen to be based in the New York City area, and the Northeast, places like the Northeast, or Los Angeles, or Chicago, or even now what we're seeing in the southeastern Florida, are commanding higher multiples than many parts of the country. So a firm in New York would command a much higher multiple than, say, a firm in Detroit, or a firm in Alabama, or a firm in Idaho. So geography, excuse me, also plays a large part in the variables. Okay, larger firms traditionally go for a lower multiple and a longer payout period. Retention period usually 2 to 3 years for larger firms. And just want to go over this quickly. Never a total sale, but a combination of sale, merger, and a two-stage deal. These are, when I say larger firms, you're talking firms that are like 20 million and above. You'll see that.